From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. The best performing asset class in 2010 by far was commodities. Joining us to break down the rally and tell us what we can expect from the commodities markets this year is Sean Broderick. He, of course, is a small caps and natural resources analyst at Weiss Research and the editor of the Crisis Profit Hunter newsletter. Sean, as always, so nice to see you.
Thank you, Jamie.
All right, Sean, we know the commodities they were huge winners last year, but when you look at the rally, what trends in particular just jump right out at you?
Well, really, there are two big trends. One is the one in energy, where crude oil is up above $90 now, and the other is in agriculture. I mean, the UN's food index jumped 28% in the second half of last year, and it looks like we will see a continued rise in both oil and food this year as well.
And why is that in particular?
Well, energy, we have a global economy that's really getting back into gear. Things are starting to improve again. And so this is really starting to, pull away from the small surplus we had in the global oil supply. And that small surplus interrupted what had been a big rise in the price of oil. And we had a global recession that pulled everything down. Now we're starting to revert to that again. And you know what? Oil isn't getting any cheaper. It isn't getting any easier to find. And so therefore, we have a really tight supply. We're not really able to add to it much, and demand is increasing. When that happens, not only do you get price rises, and I'm expecting oil to go to $105 in the first half, but you can also get price spikes. A spike to $130 would not surprise me at all.
All right, let's head over to gold. That was a breakout story of 2010. Let's talk some of the other precious metals as well. Some analysts, they're expecting a big pullback this year. What is your outlook, and how would you be telling investors to play out these markets?
Well, I'm expecting a short-term pullback in precious metals. Really wouldn't surprise me. We saw gold pull below its 50-day moving average. It has lots of support below it on a technical basis, and just fundamentally, every time gold pulls back, the Asians come in and buy it. I mean, we've seen that over and over again. So I am expecting a pullback, but not a big pullback. I think the pullback will be an opportunity to get long, because by the end of this year, we'll see higher prices in both gold and silver. Other metals, well, I mean, you can look at copper. It's going higher. The other ones are too. Much of this is industrial demand. And just to get back to silver, silver is an industrial metal along with being a precious metal. And so there's two kinds of demands for silver. Again, I expect a pullback in silver, but the run-up that it sees this year could be much larger than the one we see in gold.
All right, let's talk other commodities now. Where do you think the biggest gains are going to be?
Well, I think these trends in oil and agriculture will continue. I mean, just to get to agriculture for a bit, we had terrible floods over in Australia, just hit their wheat crop, so they're going to have to downgrade a whole bunch of the wheat that they grow to animal feed, basically, because it's not going to be good enough for humans. And so we're only in January and this has already happened. Now we're having terrible floods in Brazil. Not the parts that grow soybeans, but at least the parts that grow fruit and vegetables, they're getting hammered. We're only in January. What else is going to happen this year? I expect we'll probably see more weird weather, which means that we will probably see more pressure on the global food supply. Oil, I expect that to go much higher, but within the whole commodity space, I mean, you can see areas of strength all over the place. Sugar had a great year last year, but it's probably going to still have a great year this year. Cotton, same thing. Industrial metals, especially copper again, looking very good.
Okay, well, what is the one thing that investors can do right now to position themselves for the rest of the commodities markets?
Well, here's the thing. There is no one thing. Right. And you have to be nimble. I mean, I think you really have to watch where you put your money. There's a lot of hot money floating around, especially as we get to the next round of quantitative easing. Now, many people think, we've had a change in Washington. There isn't going to be another quantitative easing. I think there is. I don't think Congress can really have much effect on what the Fed's going to do, and the Fed's going to pump a lot more money into the system. That hot money flows around, and it just finds what's going up, and that can accentuate the moves in any investment. And so when you see something like, say, wheat really start to take off again, it can really go much higher. Corn, the same thing. Gold and silver. Gold and silver, I don't think will actually do well early on in the year, but later in the year, they'll do very well. Therefore, use a pullback like the one we're seeing now to actually position you for what's happening. So to get back to your question, what's one thing you can do? There isn't really one. But if you had to do one thing, I would say buy a nice general commodity fund like the DBC, which is a broad commodity index. It holds a whole bunch of them. It should be much higher by the end of the year, and that's one way you could do it.
Okay, stick around, Sean. We're going to bring you back for our roundtable discussion on outlooks for 2011. Tony Sagami and Rudy Martin will also be there. Thanks again, Sean.
Thank you.
One major cause of the huge run-up in commodities last year was increased demand from Asia. Joining us with his thoughts on the trends that shaped the Asian markets in 2010 and what they can tell us about the future is Tony Sagami, the editor of the Asia Stock Alert newsletter. He comes to us on Skype from Bangkok, Thailand. Hello, Tony.
Hi, Jamie. Good to be here.
Tony, right out of the chute here, do you see demand for commodities from these Asian countries, especially China, growing even more this year?
Oh, boy, you bet they will. China has almost an insatiable appetite for energy, and oil has gotten most of the commodity headlines. Let me give you a little factoid. Over the last decade, China's oil consumption has increased by an annual compounded rate of 7% a year. You know, that's a big, big number. And here's another anecdotal piece. Baker Hughes is a big company that rents out oil rigs to exploration companies. Last year, they rented an average of 269 oil rigs a day to the Asia-Pacific basin. That's an 11% increase over the 243 they did in 2009. More importantly, that energy trend of growth is not expected to peak until 2025. And so there's a lot more of Chinese and Asian oil demand coming up down the road.
Okay, Tony, so what is your outlook for economic growth in China, and how is that going to affect its stock market?
Sure, you know, the Wall Street experts have underestimated China for decades, and I think that's still true today. You know, the pinstripe crowd in Manhattan expects the Chinese economy to grow by 9% in 2011. That's a pretty big number, but I still think it's way too low. What they're overlooking is the booming domestic consumption side of the Chinese economy. You know, China is no longer just the manufacturing workshop of the world, churning out cheap trinkets, clothes, and electronics. China's own domestic consumption is the unheralded growth engine of the Chinese economy. You know, the most recent Purchasing Managers Index showed that domestic demand has increased faster than exports over the last 5 years. And here's a little factoid for you. Retail sales in China increased by 18.5% in 2010. That's a big number. Lastly, the Communist Party has made domestic consumption one of their top priorities in their new 12th fifth-year plan.
Okay, so given this rosy outlook that you have for Chinese stocks, where specifically would you recommend investors put their money to see some big returns in 2011?
Sure, I think the best strategy for international investing in 2011 is going to be taking profits out of those red-hot markets that did the best in 2010 and redeploy that money to the markets that did the worst or underperformed. You know, for example, my Asia Stock Alert subscribers just took profits of 44 and 50% out of Indonesia. We sold the largest coal producer in Indonesia as well as the largest cement producer. And so what we're doing is rotating out of the hot into the cold. Now, I don't expect that Chinese underperformance. And by the way, Indonesia was up by 46% last year, and the Chinese Shanghai index was down by 14. That underperformance is not going to last. So the best opportunities in China, and that's why it's the #1 country to invest in 2011.
Okay, Tony, Japan, as you well know, used to be the world's second largest economy. That title now goes to China. What is your outlook, though, for the Japanese market?
Boy, not good in a short. You know, Japan is still stuck in their deflationary spiral, and its recent strength in the yen is an impossible headwind for this export-dependent country. Here in 2010, the Japanese yen increased by 15%. So that means their products are 15% more expensive for their customers. Now, there's some selected Japanese companies that are doing really well, like Komatsu, because they're selling gangbusters to the Chinese. And so you can pick and choose some very selected opportunities, but Japan as a whole is not very attractive.
Okay, let's turn away from the two biggest economies in the region and let's hit some of the smaller countries. What lesser-known markets could investors see some big growth potential this year?
Sure, the key is to look for countries that are very rich in natural resources. And there's a few that are really blessed with that. Malaysia, Indonesia, and Australia are three of the most commodity-rich countries in Asia. I just got back from Malaysia a couple days ago, and it's at the top of my radar screen right now. The Malaysian stock market was up 19% last year, but it still has a lot of room to go because it's one of the largest producers of tin, rubber, and palm oil in the world. And it's also one of the largest non-OPEC oil producers in the world also. Here's a little factoid. 44% of the Malaysian government's income came from its own state-owned oil company. So that gives you an idea of how much oil they have. And don't forget about the other China, I'm talking about Taiwan, which is one of the big technology powerhouses of the world.
All right, Tony, we're going to bring you back a little bit later for our roundtable discussion on the international and commodities markets. We'll see you then. Thank you.
Thank you, Jamie.
Another part of the world that saw huge returns last year was Latin America. Our next guest has been finding value in those markets for years now and says 2011 will be no different. Rudy Martin is an emerging market specialist at Weiss Research and the editor of Emerging Market Winners, as always. So good to see you, Rudy. All right, first of all, what are the mega trends that you're seeing that are really changing the face of Latin America these days?
You know, there are a lot of trends that I've been following over the last year, but the one that's really the dominant one that will provide a lot of opportunities for us will be more people buying more things in more places in Latin America. Unlike 10 years ago, where a lot of the economy really was based on import and export of natural materials, and while that's still a positive factor, you have now really the emergence of the emerging market consumer, and that's a really important part of the story going forward.
You know, so much of the news that we hear financially, so many of the hot stories and picks are coming out of Brazil. Will that continue to be the case in 2011?
You know, well, Brazil will mostly still be the focus of attention, but there are really attractive plays in places like Colombia, Panama, Argentina, as a matter of fact. You know, the other day I made a commentary on the money and markets about the auto industry in the emerging markets and how there's a lot more production being made, more cars are being produced there. And places like Brazil and Argentina are the places where these cars are being produced and also sold. So there's a tie-in between these countries now that didn't exist before.
Lots of synergy between these nations that didn't exist. What other big developments that you see that are going to have a major impact on Latin America, not only this year, but in years to come?
Well, you know, you have a demand for infrastructure. As I said, more people, more places, more things. They've got to, you know, in addition to the demand for more autos, demand for more roads, more communications, you know, obviously government services, and also financial services as well.
Okay, let's talk stocks now. What sectors, what Latin American commodities specifically do you think are going to present the best investment opportunities?
Right. You know, again, it's still primarily a commodities play. If you're going to do that, I think the one to do is a company called Vale, ticker symbol VALE, and that's the iron ore producer out of Brazil. A lot of its business comes from China. The demand for China continues to outstrip the supply, and that's going to be a winner in the not too distant future again. Another one that I really like is a company called Ecopetrol, which is the Colombian petroleum company. And you know, the first thing that you would normally think of in terms of an energy stock would be something like a Petrobras. But Petrobras did a large capitalization, has really reduced the upside of the stock. As a matter of fact, Petrobras, unfortunately, has been one of the worst performing energy stocks next to BP, as a matter of fact, over the last 12 months. In contrast, Ecopetrol is up 75% over the last year and still has some real major opportunities. They're actually acquiring some of the BP operations in their market. They're increasing their dividends. They've got additional float. That's going to be a very attractive name. I like those two plays, Vale and Ecopetrol.
Any recommendations out there for any particular sectors that our viewers may not have heard of?
Right. You know, I mentioned the financial services at the end of my dialogue about trends. And, you know, I'm not talking about, at this point, the consumer services, because you have, in places like Brazil, some of the highest rates, and one of the ways that the country may reduce the amount of inflation is to increase rates, and that's not a positive for most financial institutions. But the one company that I like is a company called Bladex, ticker symbol BLX. It's a Panamanian interregional development bank selling at a discount to book. It should be a premium. As a matter of fact, I don't know if you remember, I came on this network talking about it. It was a $12 stock. It's 18 now and headed higher. It's one of the main picks in my new service, Emerging Market Winners.
Okay, Rudy Martin, thank you for your time.
Thank you, Jamie.
Rudy's going to be back a little bit later along with Sean Broderick and Tony Sagami for a broad discussion of the international and commodities markets in 2011. First, though, Jen Amos will join us with this week's Picks and Pans from all of the Weiss Research editors. As always, if you have any questions or comments, just email us at weissmoneynetwork@weissinc.com. We may not be able to respond to all of your emails or address them on air, but we keep everything on hand for future episodes, and we always appreciate the feedback. Money and Markets will be back in just a moment.